Markets have always been unpredictable. Prices rise and fall with a speed that can unsettle even the most experienced investor. Benjamin Graham understood this, and he taught that volatility is not an enemy, but a fact of investing life. For the defensive investor, the challenge is not to predict every swing, but to navigate it calmly, protect capital, and make rational decisions amidst the noise. Imagine the market as a stormy sea. Waves of fear and euphoria crash against every investor. Some are tossed about, reacting impulsively to each surge, while others steer steadily, guided by principles that withstand turbulence. Graham's teachings are the compass for those who seek steady progress, regardless of temporary chaos. In this video, we will explore how a defensive investor can approach market volatility, drawing on Graham's timeless insights, historical examples from his lifetime, and lessons that resonate in today's markets. We will learn how to distinguish temporary market noise from long-term trends, how to construct a resilient portfolio, and how patience and discipline can transform volatility from a threat into an opportunity. But what Graham realized about defensive investing was not just about avoiding losses. It was about recognizing that the market itself offers opportunities to the prepared and disciplined. And sometimes, the best move is not the flashiest, but the most prudent. Benjamin Graham viewed the defensive investor as someone who seeks safety first, prioritizing preservation of capital and steady returns over speculative gains. This approach is grounded in discipline, prudence, and a deep understanding of market behavior. For Graham, defensive investing was not about excitement or chasing trends. It was about preparation, patience, and rational analysis. At the core of his philosophy are several enduring principles. First, margin of safety. Always invest at a price below the intrinsic value of the asset, providing a cushion against mistakes or market swings. Second, diversification. Spreading investments across various industries and companies reduces exposure to any single risk. Third, reliance on fundamentals. Analyzing earnings, balance sheets, and dividends ensures that investments are backed by real, tangible value, not market speculation. Graham also emphasized that market volatility is normal and inevitable. Prices fluctuate, not just because of economic events, but because of investor psychology. Fear, greed, and herd behavior often drive the market further than reason dictates. Defensive investors accept this reality. They do not attempt to time every swing, but instead prepare their portfolios to withstand uncertainty. By adopting this philosophy, the defensive investor avoids the emotional traps that can destroy wealth. Panic selling, chasing hot stocks, or overreacting to market headlines are behaviors Graham warned against. Instead, patience, careful analysis, and adherence to principle become the tools that allow an investor to navigate turbulence calmly and effectively. Yet to fully understand why Graham emphasized these strategies, we need to look at the historical market turbulence that shaped his thinking. Benjamin Graham's lessons on defensive investing were forged in the fires of history. The stock market crash of 1929 and the ensuing Great Depression provided a brutal education in the dangers of speculation and the importance of financial resilience. In the 1920s, markets were euphoric. Companies boasted rising profits, and investors, caught in the tide of optimism, chased ever higher stock prices. Dividends were generous, and growth stories seemed endless. Yet when the bubble burst, the consequences were catastrophic. Stocks that once promised wealth plummeted, and many investors, unprepared for such volatility, suffered devastating losses. Graham observed that panic often caused more damage than the market itself. Investors who sold in fear realized permanent losses, while those who maintained discipline and focused on fundamentals fared much better in the long term. These experiences impressed upon him the critical importance of capital preservation, cautious selection, and rational decision-making.
The Great Depression further reinforced these lessons. Companies with strong balance sheets, steady earnings, and disciplined management survived the storm. Those reliant on speculation, debt, or hype collapsed. Graham understood that market volatility was a test of both a company's resilience and an investor's temperament. These historical experiences laid the foundation for Graham's defensive strategies. He learned that while markets fluctuate and panic is contagious, Disciplined, prepared investors could protect their wealth and even find opportunity amidst chaos. The next step is to understand the core strategies Graham recommended for defensive investors and how they help navigate volatile markets. Graham's defensive investor is guided by strategy, not speculation. He emphasized practical, disciplined approaches that reduce vulnerability to market swings while preserving capital. The first cornerstone is asset allocation. Graham recommended balancing investments between stocks and bonds, adjusting the mix according to individual risk tolerance, but always ensuring a significant portion of the portfolio is shielded from extreme volatility. Bonds provide stability, while carefully selected stocks offer growth potential without unnecessary risk. Next is diversification. By spreading investments across multiple industries and companies, the defensive investor avoids overexposure to any single failure. Graham saw firsthand during the Depression how concentrated portfolios could be devastated, while diversified holdings survived and even prospered. The third principle is selection of quality stocks. Defensive investors should seek companies with strong balance sheets, consistent earnings, and a history of paying dividends. These traits indicate financial discipline and resilience, essential qualities for weathering volatile markets. Graham stressed that the goal is not to chase trends or the latest hot stock, but to invest in businesses that demonstrate long-term stability. Finally, Graham advised avoiding speculation. Defensive investors must resist the lure of rapid gains promised by market fads or hype. Instead, they should follow a rational, rules-based approach, buying when prices are reasonable relative to intrinsic value, maintaining a diversified and balanced portfolio, and staying disciplined even when markets are turbulent. Through these strategies, defensive investors can navigate volatility with confidence, focusing on protection and consistency rather than gambling on market timing or emotion-driven opportunities. Yet even with these strategies, understanding intrinsic value and margin of safety remains central to avoiding losses during market fluctuations. At the heart of Graham's defensive philosophy lies the concept of intrinsic value, the true underlying worth of a company independent of market noise. He taught that stock prices fluctuate for reasons often unrelated to fundamentals. Investor sentiment, rumors, and short-term economic events can push prices far above or below intrinsic value. The defensive investor protects against these swings through a margin of safety, buying assets at a significant discount to their intrinsic value. This buffer serves as insurance against errors in analysis, unforeseen market declines, or economic shocks. For Graham, the margin of safety was not a luxury. It was a necessity for anyone seeking to preserve capital in an unpredictable market. Historical examples from Graham's era illustrate its importance. Companies that appeared cheap during the roaring 1920s sometimes collapsed when economic conditions changed, revealing their lack of intrinsic strength. Conversely, firms with strong fundamentals but temporarily depressed stock prices offered tremendous opportunity. Investors who recognized this, purchasing below intrinsic value, were rewarded as markets eventually corrected. The margin of safety is particularly relevant during volatile markets. Prices may swing wildly in a single day, driven by emotion rather than reason. By focusing on intrinsic value rather than headlines, the defensive investor avoids panic-driven decisions, maintains composure, and ensures that losses are limited even in turbulent conditions. Modern markets may differ in speed and complexity, but the principle remains timeless. Buy with a cushion, avoid overpaying, and let rational analysis guide your decisions even when volatility tempts you to act impulsively.
Understanding intrinsic value and margin of safety prepares investors for the next critical challenge, managing emotions and psychology in fluctuating markets. Graham understood that the most dangerous swings in the market often originate not from the economy, but from investor psychology. Fear and greed amplify volatility, causing stock prices to overshoot both on the upside and downside. The defensive investor's challenge is to remain rational when others are panicking or euphoric. During the 1929 crash, investors who reacted emotionally suffered devastating losses. Panic selling drove prices far below intrinsic value, while speculative buying before the crash inflated values beyond reason. Graham observed that those who followed their emotions rather than fundamentals were often wiped out, while patient, disciplined investors preserved capital and eventually prospered. He famously described the market as a voting machine in the short term, but a weighing machine in the long term. Short-term fluctuations reflect popularity and sentiment, but over time, fundamentals prevail. Understanding this distinction allows the defensive investor to resist impulsive decisions, avoid chasing trends, and focus on the intrinsic quality of investments. In modern markets, the psychological pressures are even greater. Social media, instant news, and algorithm-driven trading magnify swings and emotional reactions. Graham's lesson remains vital. Don't let headlines dictate your actions. Base decisions on disciplined analysis, not the crowd's mood. By controlling emotional reactions and focusing on rational criteria, defensive investors can navigate volatile periods calmly, turning potential panic into strategic opportunity. But rational decision-making is only effective when combined with a well-constructed portfolio designed to withstand market swings. Constructing a defensive portfolio is where theory meets practice. Graham emphasized simplicity, prudence, and balance, an approach designed to protect capital while generating reasonable returns over time. The foundation is asset allocation. Graham recommended dividing investments between high-quality stocks and bonds, adjusting the mix according to individual risk tolerance, but never neglecting either component. Bonds provide stability and predictable income, cushioning against market shocks. Stocks offer growth potential, but only when carefully selected for financial strength and dividend reliability. Diversification is equally essential. By spreading investments across industries and companies, the defensive investor reduces exposure to any single sector's volatility. A concentrated portfolio might deliver big gains in good times, but it can be catastrophic when markets turn. Graham insisted that diversification is a safeguard, not a limitation. It protects wealth without sacrificing long-term potential. Stock selection should prioritize financial stability and consistent earnings. Companies with strong balance sheets, conservative debt, and a history of dividend payments are less likely to falter during economic turbulence. Graham advised defensive investors to avoid speculation, even in promising sectors, focusing instead on businesses with proven durability. Finally, simplicity is a virtue. Graham cautioned against complex strategies, excessive trading, and chasing trends. A defensive portfolio need not be elaborate. It must be resilient, rational, and rooted in fundamentals.
Patience and discipline are the investor's allies, allowing them to weather volatility while staying aligned with long-term goals. With a solid defensive portfolio, the investor is prepared for inevitable market fluctuations, but understanding lessons from Graham's era applied today reveals how timeless these principles truly are. Though Graham developed his principles nearly a century ago, their relevance has not diminished. Modern markets may move faster, globalize more deeply, and incorporate technology that Graham never imagined, but the challenges of volatility, speculation, and emotional investing remain the same. Consider recent market events: the tech bubble of the late 1990s, the 2008 financial crisis, or sudden corrections driven by geopolitical events or macroeconomic fears. Investors who chased hype without regard for fundamentals often suffered steep losses, while investors who adhered to defensive principles, focusing on quality, diversification, and margin of safety, emerged largely intact.
Even dividend-paying companies today mirror Graham's lessons. Firms with strong cash flow, low debt, and a history of prudent management tend to withstand economic downturns, just as the resilient firms of the 1930s did. Conversely, high-yield, debt-laden, or speculative businesses may falter in turbulent times, demonstrating that superficial appeal rarely guarantees security. Graham's era also teaches patience. Defensive investors often benefit from waiting for opportunities to purchase undervalued assets rather than reacting impulsively to short-term market swings. In a world dominated by rapid news cycles, social media, and algorithmic trading, the ability to remain calm, disciplined, and rational is perhaps more valuable than ever. By translating Graham's lessons to today's context, we see that defensive investing is not outdated theory, it is timeless strategy. Its focus on protection, consistency, and rationality equips investors to navigate uncertainty while preserving capital and opportunity. Yet, even with these lessons, Graham offered counterintuitive insights that challenge conventional thinking. One of Graham's most powerful lessons is that sometimes doing less is more. In times of market chaos, resisting the urge to act, holding steady instead of chasing trends, can protect capital and position investors for long-term gains. While most are driven by fear or greed, the defensive investor's patience becomes a strategic advantage. Graham also challenged the assumption that higher yields always indicate better returns. Companies offering unusually high dividends may be masking financial weakness or relying on unsustainable profits. Conversely, moderate, consistent dividends often reflect stability, prudence, and management discipline, qualities that serve defensive investors far better over decades. Another counterintuitive insight is the value of temporary setbacks. When a company reduces dividends to strengthen its balance sheet or reinvest in growth, it may appear weak, yet such actions can secure long-term resilience. Defensive investors who understand this principle recognize that short-term fluctuations are not failures, but opportunities to assess true strength. These lessons remind us that defensive investing is not about avoiding volatility entirely, but about navigating it wisely. By valuing stability over flash, patience over panic, and fundamentals over hype, investors can maintain steady progress even in turbulent markets. Understanding these counterintuitive truths prepares us to apply Graham's wisdom practically today, evaluating companies, constructing portfolios, and making decisions that withstand volatility while preserving capital. Next, we explore practical application, evaluating and acting on defensive strategies in today's markets. Benjamin Graham's guidance for defensive investors transcends time. Market volatility is inevitable, but losses are not. By adhering to principles of capital preservation, diversification, margin of safety, and disciplined analysis, investors can navigate uncertainty with confidence.
The defensive investor does not chase headlines, hype, or the promise of instant wealth. Instead, they focus on fundamentals, rational decision-making, and patient execution. A balanced portfolio between high-quality stocks and bonds, with carefully selected companies that demonstrate consistent earnings and prudent management, forms a resilient foundation. Graham's lessons remind us that volatility is not an obstacle, but an opportunity to apply rational judgment. Short-term swings may tempt panic or impulsive action, but long-term success comes to those who prepare, stay disciplined, and act only when fundamentals justify it. In today's fast-paced, interconnected markets, these principles are more relevant than ever. Social media-driven sentiment, rapid news cycles, and algorithmic trading amplify short-term swings. Yet the defensive investor who trusts in intrinsic value, margin of safety, and patience can weather any storm. Ultimately, Graham's wisdom is clear. The path to steady, enduring success is neither flashy nor complicated. It lies in preparation, discipline, and the courage to remain rational when the world around you grows chaotic. By internalizing these lessons, the defensive investor not only protects capital, but builds wealth sustainably, turning market volatility from a threat into an opportunity. The market may be unpredictable, but your approach doesn't have to be. With Graham's principles, you are equipped to invest wisely, navigate turbulence, and endure for the long term.